Before we begin, it's crucial to state that I am not a registered financial advisor, and this presentation is for educational and informational purposes only. The content in this video should not be considered financial, legal, or tax advice. Refinancing your home is a major financial decision, and you should always consult with a qualified, licensed professional who can assess your individual situation before taking any action. You know that feeling, that specific day of the month when you check your bank account and you see it. That massive chunk of money gone. Your mortgage payment. It's the biggest bill most of us will ever have, and for a split second a question flashes through your mind. Am I being taken for a ride? With all the headlines about interest rates going up, down, and sideways, am I stuck in a bad deal flushing hundreds, maybe even thousands of dollars down the drain every single year? That nagging feeling that you might be overpaying is one of the worst because it feels like you're losing a game you don't even know the rules to. Well, today we're going to change that. I'm going to give you the rule book. I'm going to show you a simple, powerful method to cut through all the noise and find out exactly what mortgage refinance rate you could be getting right now. This isn't about theory. This is a practical, step-by-step guide to taking back control. We're going to expose the secrets the big banks and lenders would rather you didn't know. And we're going to do it all from the comfort of your own home, in less time than it takes to watch an episode of your favorite show. The stakes here are enormous. Let's just talk numbers for a second. On a $300,000, 30-year mortgage, the difference between a 6.5% interest rate and a 6% interest rate isn't just 0.5%. That's a difference of over $170 a month. That's over $2,000 a year. Over the life of the loan, that single 0.5% difference costs you more than $61,000. That's a new car. That's a college fund. That's a life-changing amount of money. And right now, millions of Americans are paying that extra half point or more, simply because they don't know how to navigate the confusing world of online rate shopping. They get overwhelmed by the jargon, intimidated by the process, and they just give up. We are not going to let that happen to you. By the end of this video, you will have a rock-solid foundation. You will understand the landscape of online mortgage rates better than 99% of homeowners out there. I will arm you with the knowledge to walk past the flashy ads and the misleading teaser rates and identify a genuinely good deal. We are going to demystify the entire process so you can move forward with total confidence. So where do we start? Most people think the first step is to Google best mortgage refinance rates and click the first link. That is a huge mistake. It's like walking into a car dealership and yelling, "I'll take any car, just give me your best price." You're immediately at a disadvantage. The lenders, the advertisers, the comparison websites, they have set up a system designed to confuse you. They want you to focus on one big shiny number, the interest rate. But that number is only half the story. The very first secret you need to understand is the critical difference between the interest rate and the APR, or annual percentage rate. They are not the same thing, and confusing them can cost you a fortune. The interest rate is simply the cost of borrowing the money, expressed as a percentage. It's the number they put in giant font in their ads. But the APR is the true cost of the loan. It includes the interest rate plus all the lender fees, closing costs, and points rolled into the loan and expressed as a percentage. Think of it this way: you see two lenders advertising a refinance. Lender A offers a 6% interest rate. Lender B offers a 6.1% interest rate. Naturally, you'd think Lender A is the better deal, right? But then you look closer. Lender A's APR is 6.45% because they're charging you $7,000 in closing costs and fees. Lender B, with the slightly higher interest rate, has an APR of 6.25% because their fees are only $2,000. In this case, Lender B is the significantly cheaper loan over the long run. The APR tells the truth. The interest rate just tells a nice story. Always compare loans using the APR, not just the advertised interest rate. That piece of knowledge alone puts you ahead of the game. But before we can even start looking at APRs from different lenders, we have to take a step back. Because the rates you see online are not the rates you will necessarily get. They are benchmark rates based on a perfect imaginary borrower. To find out what your actual rate will be, you first need to understand what the lenders see when they look at you. You have to know your own financial snapshot. Lenders are in the business of managing risk. The less risky you appear to them, the lower the interest rate they will offer you. It's that simple. And they measure your risk using three primary numbers. These are the three pillars of your financial identity in the eyes of a mortgage lender. Getting these numbers right is the single most important thing you can do to unlock the lowest possible refinance rates. Pillar number 1 is your credit score. This is the big one. You've heard about it a million times, but for a mortgage, it is everything. This 3-digit number is a summary of your history of paying back debt. To a lender, a high credit score, think 760 or above, screams responsible and reliable. It means you're a low-risk borrower, and they will compete for your business by offering you their absolute best rates. A lower score, say below 680, signals higher risk. It tells them there's a greater chance you might struggle with payments. To compensate for that risk, they will charge you a significantly higher interest rate. The difference between a top-tier and a mid-tier credit score can easily be a full percentage point on your mortgage rate. We're talking tens, even hundreds of thousands of dollars over the life of the loan. Knowing your exact credit score isn't optional. It's the price of admission to the world of refinancing. Pillar number 2 is your loan-to-value ratio, or LTV. This sounds complicated, but it's incredibly simple. It's just the amount of your mortgage divided by the current appraised value of your home. For example, if you owe $200,000 on your mortgage and your home is now worth $400,000, your LTV is 50%. This number tells the lender how much equity, or ownership, you have in your home. From their perspective, the more skin you have in the game, the better. A low LTV, meaning you have a lot of equity, makes you a much safer bet. Why? Because if you stop making payments, the bank knows they can sell the house and easily recoup their money. Most lenders want to see an LTV of 80% or less to offer the best rates and to avoid requiring you to pay for private mortgage insurance, or PMI, which is another costly fee. And that brings us to pillar number 3, your debt-to-income ratio, or DTI. Again, the name sounds technical, but the concept is straightforward. Your DTI is all of your monthly debt payments. That means your future mortgage payment, car loans, student loans, credit card minimum payments, all added up, and then divided by your gross monthly income. That's your income before taxes. So if your total monthly debt payments are $3,000 and your gross monthly income is $8,000, your DTI is 37.5%. This number tells the lender how much of your monthly income is already spoken for. A high DTI signals that your budget might be stretched thin, making you a riskier borrower. A lower DTI shows them you have plenty of breathing room in your budget to comfortably handle the mortgage payment. Most lenders look for a DTI of 43% or lower to offer their most competitive rates. These 3 numbers, credit score, loan-to-value, and debt-to-income, are the keys. They are the entire foundation. Before you ever fill out an online form or speak to a loan officer, you must have a firm grasp of these 3 figures. They dictate the quality of the offers you will receive. Going into the process blind to these numbers is like trying to navigate a maze in the dark. But knowing them, understanding them, and preparing them beforehand is like being handed a map and a flashlight. Changes everything. It puts you in the driver's seat. So let's get you in that driver's seat. The very first thing you do when you have a map isn't to look at the destination. It's to find that little red that says, "You are here." You have to know your exact starting coordinates before you can even think about plotting a course. In the world of refinancing, that "you are here," that is what we'll call your financial snapshot. This isn't just a pile of paperwork. This is your personal confidential dossier. It's the complete, unvarnished truth of your financial life, assembled in one place. And creating it is the single most powerful step you can take before you ever type mortgage rates into a search bar. Why? Because the entire refinance game is played on this field. Lenders are professional risk assessors. They're trying to answer one question. If we give this person a massive loan at a great rate, how certain are we that they'll pay it back? Your financial snapshot is your answer. It's your evidence. It's your argument. A weak, disorganized snapshot gets you a polite "no thanks" or a painfully high interest rate. A strong, well-prepared snapshot gets you the keys to the kingdom. So let's build it piece by piece. There are 3 core pillars to your financial snapshot: your income, your assets, and your debts. Let's start with the engine of your financial life: your income. This seems obvious, right? It's what you make. But it's so much more nuanced than that. Lenders don't just want to know your salary. They want to see proof, consistency, and stability. They want to see a story of reliability. So your mission here is to gather the evidence that tells that story. You're going to need your most recent pay stubs, typically from the last 30 to 60 days. Don't just grab one. Get a few. They show your gross pay, your net pay, your year-to-date earnings, and any deductions. This is the frontline proof of your current earning power. Next, you need the big guns, your W-2 forms from the last 2 years. The W-2 is the official, government-stamped summary of your earnings from an employer. Having 2 consecutive years of W-2s from the same company tells a powerful story of stability. It screams low risk. If you've changed jobs, that's perfectly fine, but you'll need the W-2 from your previous employer as well. The goal is to show a continuous 2-year history of employment and income. Now, along with those W-2s, you're going to want your federal tax returns for the last 2 years. All pages, not just the summary. Lenders will scrutinize these. They're looking for consistency between what your W-2 says and what you reported to the IRS. But they're also looking for other sources of income. You might have declared side hustles, rental income, investment gains. And this is a critical point for so many people in today's economy. Are you a freelancer? A gig worker? Do you have a side business? If so, your income story is told through 1099 forms, and your business's profit and loss statements. For self-employed individuals, this part is even more crucial. You'll need at least 2 years of business tax returns and a detailed profit and loss statement for the current year. The key is to paint a clear, undeniable picture of a stable, or ideally a growing income stream. Don't just think about your 9 to 5. Think about everything. That freelance graphic design work you do on weekends? That's income. The rental income from a property you own? That's income. Alimony or child support? That's income. Gather the documentation for every single dollar that comes in. You are building a case for your financial strength, and every piece of evidence matters. You might be surprised at how much more powerful your profile looks when you account for everything. The second pillar of your financial snapshot is your assets. If income is the engine, assets are your reserve fuel tanks. They represent your financial stability and your ability to handle unexpected storms. This is the money you have saved and invested. The first and most obvious thing you'll need are your bank statements, checking and savings. Lenders will want to see the last 2 to 3 months of statements for all your accounts. They're looking for a few things here. First, do you have enough cash on hand to cover the closing costs of the refinance? Second, do you have reserves? This is huge. Having a few months' worth of mortgage payments sitting in a savings account shows that if you lost your job tomorrow, you wouldn't immediately default. It makes you an incredibly attractive borrower. When you gather these statements, download the full versions with all pages, not just the summary page. Every transaction might be scrutinized to make sure there are no large, unexplained deposits, which can be a red flag for undisclosed loans from family or friends. But your assets go far beyond your checking account. We're talking about your retirement accounts, your 401k, your 403b, your IRA. Get the most recent quarterly statements for all of them. While you can't typically use this money directly for closing costs without penalties, it demonstrates your long-term financial health and responsibility. It shows you're a planner. It adds serious weight to your profile. Do you have any brokerage accounts? Stocks, bonds, mutual funds? Print out those statements too. The more you can show, the better. Think of it from the lender's perspective. They see someone with a steady income, cash in the bank, and a healthy retirement fund. That person is the opposite of a risk. That person is a prime candidate for the best possible interest rate. Now for the third pillar. This is the one nobody likes to look at, but it's arguably the most important: your debts. Your liabilities. If your income is your power and your assets are your reserves, your debts are the weight you're carrying, and you have to know exactly how much it weighs. Being brutally honest here is non-negotiable. This isn't just about your current mortgage. You need to compile a complete list of every single financial obligation you have. Start with the big ones: car loans, student loans. Get the most recent statements for each, showing the total amount you owe and your required minimum monthly payment. Then move on to revolving debt, credit cards, all of them, even the one you never used that has a zero balance. Get the latest statement for every single card. You need to know the total balance and the minimum monthly payment for each. Don't forget personal loans, lines of credit, or any other installment loans. The goal is to create a master list. On one side, write down the creditor like Honda Financial or Chase Visa. In the next column, write the total balance you owe. And in the final column, write your required minimum monthly payment. Add up that last column, that total number. The sum of all your minimum monthly payments for all your debts, including your current mortgage, is one of the most critical numbers in this entire process. Because what lenders are going to do is take that number and compare it to your gross monthly income. This calculation is called your debt-to-income ratio, or DTI. It's a simple percentage that tells them how much of your monthly income is already spoken for by debt payments. And right now, that ratio is one of the gatekeepers of the entire lending industry. A high DTI can stop a refinance application dead in its tracks, no matter how high your income is. We're going to dive deep into the DTI ratio and exactly what numbers you need to hit in a later part, but for now, the mission is simply to get the raw data, to face the numbers head-on. So now take a step back. Look at what you've assembled. You have your proof of income, the story of your earning power. You have your proof of assets, the story of your stability and your safety net. And you have a complete list of your debts, the unvarnished truth of your financial obligations. This is it. This is your financial snapshot. This dossier you've just created is more valuable than any online rate calculator. Because with this information in hand, you are no longer a passive consumer hoping for a good deal. You are an informed, prepared applicant ready to negotiate from a position of strength. You've turned on the lights in the maze. You've pinpointed your location on the map. You now know your own financial DNA better than anyone. And with that knowledge, you're ready to take the next step. You're ready to understand the single most important number that lenders will use to judge you. A number that can save you or cost you tens of thousands of dollars over the life of your loan. A number that is, for better or for worse, the gatekeeper to your financial future. Your credit score. Your credit score. Think of it less as a grade and more as a single powerful number that tells a story. It's your financial reputation, boiled down to a 3-digit summary. To a mortgage lender, it's a risk assessment. It's their crystal ball, attempting to predict one thing and one thing only. How likely are you to pay back the hundreds of thousands of dollars they're about to lend you? And the story that number tells will directly determine the interest rate you are offered. Not maybe, not sometimes. It will. Let's make this real. Forget abstract percentages for a second. Let's talk about two people, Sarah and Tom. Sarah and Tom live in the same town. They work for the same company, they have the same job title, and they earn the exact same salary down to the penny. Both bought their homes a few years ago, and now have an outstanding mortgage balance of $400,000. Both see the current rates and realize it's the perfect time to refinance, to lower their monthly payment and save some serious cash. On paper, they are identical candidates, but they have one critical difference. Sarah has been meticulous with her finances for years. She pays every bill on time, keeps her credit card balances low, and thinks carefully before opening any new accounts. Her credit score is a stellar 780. Tom, on the other hand, has been a bit more relaxed. He's not a bad guy, he just hasn't paid close attention. He's missed a credit card payment here and there. He's carrying a higher balance on a few store cards from a home renovation project, and he recently applied for a new car loan. His score isn't terrible, but it's a fair 660. A 120-point difference. Doesn't sound like a chasm, does it? It sounds like the difference between a B+ and an A+ on a test. But in the world of mortgage lending, that gap is the Grand Canyon. When the lender pulls their files, they see two completely different stories. They see Sarah, the A+ student. She is a low-risk prime borrower. They're not just willing to give her a loan, they're competing for her business. They roll out the red carpet and offer her their best possible rate. Let's say it's 6.5%. Then they look at Tom. They don't see Tom, the person. They see the number, 660. They see a higher risk. The late payments are blips on the radar. The higher credit card balances suggest he might be overextended. To the lender's algorithm, he is statistically more likely to default than Sarah. So, they'll still give him a loan, but they're going to charge him a premium for that added risk. They offer him a rate of 7.5%. 1 percentage point. That's it. Tom might even think, 1%? I can live with that. It's not a huge deal. And that is the single most expensive mistake a homeowner can make. Let's do the math. On a $400,000, 30-year fixed mortgage, Sarah, with her 6.5% rate, has a monthly principal and interest payment of $2,528. Tom, with his 7.5% rate, has a monthly payment of $2,797. That's a difference of $269 every single month. That's a car payment. That's a week's worth of groceries for a family. That's a significant chunk of your retirement savings, month after month for years. But the monthly payment is just the beginning of the horror story. Let's zoom out. Let's look at the total interest paid over the entire 30-year life of the loan. Sarah, our A+ student, will pay a total of $510,000 in interest over 30 years. A staggering number, but that's how mortgages work. Tom, however, with that small 1% higher rate, will pay a total of $606,800 in interest. The difference, the penalty for having a lower credit score, is $96,800. Let me say that again. Nearly $100,000. Poof, gone. Not for a bigger house, not for a better neighborhood. It's for the exact same $400,000 loan on the exact same house. It's a $100,000 fee for not paying attention to a 3-digit number. It's the price of a Tesla Model S. It's a full college education at a state university. It is a life-changing amount of money. So now you see why this isn't just a number. It's the key. And if you want to get the best rate, you have to understand what's inside the lock. How is this number even calculated? It's not magic. The most common scoring model, the FICO score, is based on 5 specific factors, and each one has a different weight. First, and the undisputed heavyweight champion of them all, is your payment history. This accounts for 35% of your score. It's the most important factor, period. It answers the most basic question. Do you pay your bills on time? Every late payment, collection, or bankruptcy on your record is a major blow. Lenders see a history of late payments as a giant flashing red light. The second most important factor, at 30%, is amounts owed, more commonly known as your credit utilization. This is a bit more complex. It's not just about how much debt you have. It's about how much debt you have compared to your total available credit. Imagine you have one credit card with a $10,000 limit. If you have a $1,000 balance, you're using 10% of your available credit. That's great. But if you have a $9,000 balance, you're using 90%. That's a major red flag. It signals to lenders that you might be financially stressed and living too close to the edge. The general rule of thumb is to keep your utilization below 30% on each card and overall. Next up, at 15%, is the length of your credit history. This is about stability. Lenders like to see a long, established track record of responsible credit management. It looks at the age of your oldest account, your newest account, and the average age of all your accounts. This is why financial advisors scream from the rooftops, do not close your oldest credit card. Even if you don't use it, that card's long history is a valuable asset, anchoring your score. The fourth factor, accounting for 10%, is your credit mix. Lenders like to see that you can responsibly handle different types of credit. A healthy mix might include what's called revolving credit, like credit cards, and installment loans like a car loan or a student loan, where you pay a fixed amount each month. It shows you're a versatile and trustworthy borrower. And finally, the last 10% is new credit. This looks at how recently and how often you've been applying for new credit. If you suddenly apply for 5 new credit cards and a personal loan in a single month, lenders get nervous. It looks like you're desperate for cash, which makes you a higher risk. Each of these applications typically results in a hard inquiry on your report, which can temporarily ding your score by a few points. It's a small piece of the pie, but it matters, especially when you're about to apply for the biggest loan of your life. So that's the formula. Payment history, amounts owed, length of history, credit mix, and new credit. These 5 pillars are what build your score. And who is keeping track of all this? 3 main companies, the 3 major credit bureaus, Equifax, Experian, and TransUnion. Your lenders, credit card companies, and even some utility companies report your payment behavior to these bureaus. Each bureau then uses this data, plugs it into the FICO scoring model, and spits out a score. Now, here's a pro tip. Your score from each of the 3 bureaus might be slightly different. Why? Because not all creditors report to all 3 bureaus. It's messy, I know. When you apply for a mortgage, the lender will typically pull your credit report and score from all 3. They then use what's called the middle score for their decision. So if your scores are 740, 752, and 760, they won't use the highest or the lowest. They'll use the 752. Okay, deep breath. We've covered the shocking financial impact of your score and the DNA of how it's built. The next logical, crucial question is, what is your number? Right now, you cannot begin this journey without knowing your starting point. For years, getting your score was a mystery, often costing you money. Today, it's incredibly simple and, in most cases, free. Many of your credit card companies or banks provide a free FICO score as a perk, updated monthly right on your online statement. This is a great way to track it. But that's just the score. You also need to see the full report, the raw data behind the number. The US government has mandated that you can get a free copy of your full credit report from all 3 bureaus once a year. The official and only place to do this is annualcreditreport.com. Going there and pulling your reports is your financial homework. You need to read through every single line to check for errors. A mistake on your report, a late payment that wasn't late, an account that isn't yours, could be the difference between being a Sarah or a Tom. It happens more often than you think. Checking your own credit, by the way, is a soft inquiry. It has zero impact on your score. A hard inquiry only happens when a lender checks it as part of an official loan application. So don't be afraid to check it. You need to know that number, because once you know it, you can control it. You can improve it. Which brings us to the most important question of all. What if you check your score and your heart sinks? What if you're more like Tom than Sarah? Are you stuck paying that $100,000 penalty for the next 30 years? Absolutely not. In fact, there are specific little-known strategies you can use, sometimes in as little as 30 to 60 days, to boost that score and unlock the rates you deserve. And that's exactly what we're going to break down next. The Rapid Repair Guide to Hacking Your Credit Score Before You Even Think About Refinancing. Alright, let's talk about the single most powerful lever you can pull to change your financial future in the next 30 days. We're not talking about long-term, slow and steady strategies. We're talking about financial triage. We're talking about surgical strikes on your credit report that can yield massive results, fast. This isn't about cheating the system. It's about understanding the game better than anyone else. The credit scoring system isn't a mystery. It's an algorithm. And like any algorithm, it has rules and inputs you can influence almost immediately. The first and most explosive target is something called your credit utilization ratio. This sounds complicated, but it's brutally simple. It's how much you owe on your credit cards compared to your total credit limit. If you have a card with a $10,000 limit and a $5,000 balance, your utilization on that card is 50%. This single number accounts for a whopping 30% of your FICO score. It's the second biggest piece of the pie, right after payment history. But unlike payment history, which is built over years, you can change your utilization ratio tomorrow. Lenders are obsessed with this number. A high utilization ratio screams risk. It tells them you might be overextended, living on credit, and potentially one missed paycheck away from trouble. A low utilization ratio, on the other hand, whispers responsibility. It shows you have access to credit but the discipline not to use it all. The magic number, the gold standard that lenders drool over, is anything under 30%. But the secret of the pros, the number that gets you into the elite tier of interest rates, is under 10%. Getting from, say, 70% utilization down to 9% can boost your score by 50, 70, even over 100 points in a single credit reporting cycle. That's the kind of jump that takes you from a maybe pile to a pre-approved, red carpet treatment pile. So, how do we perform this surgery? First, the obvious. Pay down your balances. But there's a strategy to it. Don't just spread your money evenly. You want to focus your firepower on the card with the highest utilization ratio first. If you have one card that's maxed out at 98% and another sitting at 40%, attacking that maxed out card is your priority. Getting that one card from 98% down to under 30% will have a much bigger impact on your score than getting two cards from 60% down to 40%. It's a psychological win for the credit algorithm. But here's the real hack. The secret weapon most people don't know about. It's not just that you pay, it's when you pay. Your credit card company typically reports your balance to the credit bureaus once a month, on your statement closing date. This is not your payment due date. Your due date is usually about 3 weeks later. Most people charge up their card all month, wait for the statement, see a big balance, and then pay it off by the due date like a responsible adult. The problem? The credit bureaus already saw that big balance. They already recorded you at 80% utilization for the month, even if you paid it to zero a week later. The hack is to find out your statement closing date for each card. You can call the number on the back or check online, and make a large payment a few days before that date. This way, when the credit card company reports to the bureaus, it's reporting a tiny, insignificant balance. You could use the card for thousands of dollars in a month, but if you pay it down to $50 before the statement closes, as far as the credit score is concerned, you're a rock star who only used $50 of your credit limit. Do this across all your cards, and in 30 days your utilization ratio plummets, and your score skyrockets. It is the single fastest legal way to manipulate your credit score. There's one more quick trick for utilization. Ask for a credit limit increase. If you can't pay down a $5,000 balance on a $10,000 limit card, what if you could turn that limit into $20,000? Instantly, your 50% utilization becomes 25% without you paying a single dime. Many credit card companies let you request an increase right through their app or website. Often, if your account is in good standing, they'll grant it automatically without a hard inquiry that would temporarily ding your score. Just be sure to check if they'll do a hard or soft pull before you ask. A soft pull is harmless. A hard pull is something you want to avoid right before a mortgage application. Now for the second major lever, your payment history. This is the biggest factor in your score, but it feels permanent. A late payment from 2 years ago feels like a tattoo you can't remove. But you might have more power than you think. Let's say you have a single 30-day late payment from a year ago with a creditor you've been perfect with ever since. It was a mistake, you were on vacation, whatever. You can write what's called a goodwill letter. This is exactly what it sounds like. You write a polite, professional letter or email to the creditor. You explain your history of on-time payments, you take responsibility for the one-time slip-up, you explain the circumstances without making excuses, and you kindly request they make a goodwill adjustment to remove the late payment from your credit report. There is no law that says they have to do this, but you would be shocked at how often it works. Customer retention is huge for these companies. If you've been a good customer, they have an incentive to keep you happy. A single late payment removal can add 30 to 60 points to your score. It costs you a stamp or the time to type an email. It is absolutely worth the shot. The third and final rapid repair target is cleaning up the errors. You wouldn't believe how often credit reports are just wrong. According to a major study by the Federal Trade Commission, 1 in 5 consumers had an error on at least one of their credit reports. 1 in 20 had an error so serious it would cause them to be denied credit or pay significantly higher interest rates. You could have the financial habits of a saint, but if your report says you have a collection account from a cable company in a state you've never lived in, you're paying for someone else's mistake. Your mission is to become a detective. Go to annualcreditreport.com. That is the official government-mandated site where you can get your full credit reports from all 3 bureaus, Equifax, Experian, and TransUnion for free. Do not go to any other site that promises free reports but asks for a credit card. Once you have all 3 reports, print them out and go through them with a red pen, line by line. Are all the accounts listed actually yours? Are the balances correct? Are there any late payments listed that you know you paid on time? Is a closed account still showing as open? Is there a collection account you've never heard of? Anything that looks wrong, circle it. For every single error, you have the right to dispute it with the credit bureau. And the best part is, you can do this entirely online through each bureau's website. The process is straightforward. You state what's wrong and if you have it, provide any proof. By law, the credit bureaus have 30 days to investigate your claim. They have to contact the creditor that reported the information and verify it. If the creditor can't prove the information is correct, or if they simply don't respond in time, the bureau must remove the negative item from your report. Gone. Forever. Imagine finding a bogus collection account on your report, disputing it online in 15 minutes, and 30 days later seeing your score jump 80 points because it was deleted. It happens every single day. By aggressively managing these 3 areas, crushing your utilization, negotiating your payment history, and auditing for errors, you're not just hoping for a better score. You're actively building it. You're taking control. In the 30 to 60 days it takes for these changes to fully register, you can fundamentally transform your credit profile from average to excellent. You can walk into the refinance process not as a supplicant, hoping for a decent rate, but as a prime candidate who has lenders competing for your business. Now, with your credit score primed and polished, you're ready for the main event. But this is where a critical choice comes in, a choice that could be worth tens of thousands of dollars over the life of your loan. Because not all refinances are created equal. There are different tools for different jobs, and picking the wrong one, even with a stellar credit score, is like bringing a hammer to a job that needs a wrench. You need to know exactly which type of refinance aligns with your specific financial goals. Are you trying to lower your payment? Pull out cash for a renovation? Get rid of PMI? The answer determines your next move. And that's exactly what we're covering next. A complete breakdown of the different types of refinance loans, and how to choose the one that will save you the absolute most money. Alright, let's pull back the curtain on the main doors you can walk through when you refinance. Think of them as different tools for different jobs. Using the right one can save you a fortune. Using the wrong one can be a costly mistake. The most common, the one you hear about most often, is the rate and term refinance. This is the classic, the bread and butter of the refi world. Its goal is simple and pure. to change the rate, the term, or both on your existing mortgage without pulling any cash out. You're essentially swapping your old, more expensive loan for a new, cheaper one. This is the path for you if your primary goal is to lower your monthly payment, save on total interest over the life of the loan, or pay your house off faster. Let's make this real. Imagine you bought your home a few years ago with a 30-year fixed mortgage for $300,000 at a 6.5% interest rate. Your principal and interest payment is about $1,896 a month. Now rates have dropped. You check online and see you can qualify for a new 30-year loan at 5%. By doing a rate and term refinance, you could drop your monthly payment to around $1,610. That's a savings of $286 every single month. Over a year, that's more than $3,400 back in your pocket. That's a vacation. That's a significant boost to your retirement savings. That's real money. Or maybe you're in a better financial position now. You could refinance from that 30-year loan into a 15-year loan. Yes, your monthly payment might actually go up in this scenario, but the interest rate on a 15-year mortgage is almost always lower than a 30-year. You'd be building equity at lightning speed, and you would pay an astronomically smaller amount of interest over the life of the loan. We're talking about potentially saving over $100,000 in interest payments. You become debt-free decades sooner. The rate and term refi is your weapon of choice for pure financial optimization of the mortgage itself. But what if you need more than just a lower payment? What if your home isn't just a place to live, but also a financial resource you need to tap into? This brings us to the second major type, the cash-out refinance. Think of your home equity as a savings account that you've been diligently paying into every month with your mortgage payments, and that has also been growing as your home's value increased. A cash-out refinance is a way to make a withdrawal from that account. Here's how it works. You take out a new mortgage that is larger than what you currently owe. You use the new loan to pay off the old one, and the difference, the cash out, is given to you as a tax-free lump sum. Why would anyone do this? The reasons are as varied as homeowners themselves. The number one reason is home improvement. Let's say your home is worth $400,000 and you owe $200,000. You have $200,000 in equity. You need $50,000 for a new kitchen and to finish the basement. With a cash-out refi, you could take out a new loan for $250,000. That pays off your original $200,000 mortgage, and you get a check for $50,000. You get the cash you need for renovations, and those renovations will likely increase the value of your home even more. It's a powerful cycle. Another huge reason is debt consolidation. Maybe you've racked up $25,000 in high-interest credit card debt at 22% APR. That debt is an anchor, costing you a fortune in interest every month. You could do a cash-out refi, get that $25,000, and pay off all those credit cards in one fell swoop. You're trading cripplingly high-interest debt for relatively low-interest mortgage debt, often slashing your total monthly debt payments and simplifying your financial life. Of course, there's no free lunch. The trade-off with a cash-out refi is that your new mortgage balance is higher, which means your monthly payment will be higher than if you just did a rate and term refi. And because you're borrowing more, the interest rates offered are typically a tiny bit higher than a standard rate and term. You are also putting your house on the line for debts that weren't previously secured by it. So it's a decision that requires serious consideration. You have to weigh the immediate benefit of the cash against the long-term cost of the larger loan. Now there's a lesser-known cousin to the cash-out, and that's the cash-in refinance. It's the exact opposite. Instead of taking cash out, you bring cash to the closing table. Why on earth would you pay to refinance? The main reason is to get rid of private mortgage insurance, or PMI. If you bought your home with less than a 20% down payment, you're likely paying PMI every month. It's insurance that protects the lender, not you, and it can cost hundreds of dollars a month. To get rid of it, you need to have at least 20% equity in your home. Let's say your home is valued at $300,000, and you owe $250,000. You only have about 17% equity. You're stuck paying PMI, but you've saved up $10,000. You could do a cash-in refinance, bring that $10,000 to closing to pay down your principal. Your new loan amount would be $240,000. Now you have $60,000 in equity on a $300,000 home, exactly 20%. The PMI is gone forever. You've just given yourself a permanent raise by eliminating that monthly PMI payment. It's a strategic move to lower your long-term housing costs. Finally, we have a special category of refinances for those with government-backed loans. These are called streamline refinances, and they are available for FHA, VA, and USDA loans. The magic word here is streamline. These programs are designed to be fast and easy, with significantly less paperwork and lower underwriting requirements than a traditional refinance. The most popular is the VA Interest Rate Reduction Refinance Loan, or IRRL, often pronounced IRL. If you're a veteran with a VA loan, this is a phenomenal program. In many cases, you don't need a new appraisal, you don't need to provide income verification, and there's no minimum credit score required by the VA itself, though individual lenders may have their own minimums. The primary rule is that the refinance must result in a net tangible benefit to the veteran, which usually means lowering the monthly payment. It's the government's way of saying thank you for your service. Let's make it as easy as possible for you to save money. Similarly, there's the FHA Streamline and the USDA Streamline. Like the VIRRL, the FHA Streamline is for homeowners who already have an FHA loan. It also typically doesn't require a new appraisal, which saves you time and money. The goal is simply to lower your interest rate and payment. The USDA Streamline helps homeowners in eligible rural areas who have an existing USDA loan do the same. These streamline programs are fantastic options if you qualify, because they remove many of the hurdles that can make refinancing feel like a daunting process. So there you have it. The 4 main pathways. The rate-in term for optimizing your loan. The cash-out for leveraging your equity. The cash-in for strategically eliminating costs like PMI. And the streamline for a fast-track refi on a government-backed loan. Each one is a powerful financial tool. Choosing the right one depends entirely on your answer to that question we started with. What is my primary goal? Now that you know the what, the types of loans available and what they're designed to do, the next critical question is how. How do you actually get approved for one of these? What do lenders see when they look at your application? What's the magic number they're looking for in your credit score, your debt-to-income ratio, and your home's value? This isn't just about finding a low rate online. It's about making yourself the kind of borrower that lenders are eager to give that low rate to. And that's the secret sauce we're decoding next. So let's pull back the curtain on this secret sauce. Think of your financial profile like a high-performance engine. You can't just expect it to win the race without tuning it first. And right now, lenders are the race officials and the lowest rates are the trophy. There are 3 main dials you need to tune to perfection: your credit score, your debt-to-income ratio, and your home's loan-to-value ratio. Get these 3 right and you're not just applying for a loan, you're commanding the best offer. Let's start with the big one, the number that follows you everywhere: your credit score. This isn't just some arbitrary number. It's your financial reputation boiled down to a 3-digit score. To a lender, it's a direct measure of trust. A high score screams, "I'm reliable. I pay my bills on time." A low score whispers, maybe I'm a bit of a risk." And in the world of mortgages, risk is expensive. The difference between a good score of 680 and an excellent score of 760 might seem small, but on a $300,000 loan, that difference could literally cost you over $50,000 in extra interest over 30 years. $50,000 for an 80-point gap. That's a new car, a college fund, a life-changing amount of money. So how do we tune this dial? First, you need to know exactly where you stand. Go to annualcreditreport.com. That is the one official federally authorized site to get your full credit reports from all 3 major bureaus, Equifax, Experian, and TransUnion for free. This isn't just about seeing your score. It's about playing detective. You are looking for errors. A bill you paid off that's still showing as delinquent. A credit card that isn't even yours. You would be shocked how often this happens. Finding and disputing a single error can sometimes boost your score by 30, 50, even 100 points almost overnight. That's the single fastest way to improve your standing. Next, and this is non-negotiable, on-time payments. This accounts for the biggest chunk of your score, about 35%. One late payment can stick to your report like glue for 7 years, and can drop your score significantly. The solution is simple but powerful. Automate everything. Set up autopay for the minimum balance on every single one of your accounts. You can always pay more manually, but this ensures you never, ever miss a payment due to a simple oversight. The second most important factor is your credit utilization ratio. Fancy term, simple concept. It's how much of your available credit you're using. If you have one credit card with a $10,000 limit and you have a $3,000 balance, your utilization is 30%. Lenders want to see this number below 30%. Below 10% is even better. Why? Because someone who has maxed out all their cards looks like they're in financial distress. They look desperate. To a lender, that's a massive red flag. So, the mission is to pay down those balances. If you can't pay them down quickly, you can try calling your credit card company and asking for a credit limit increase. If they grant it, your balance stays the same but your available credit goes up, which instantly lowers your utilization percentage. Just don't use that new room to spend more. Finally, a few pro tips for the pre-refinance period. Don't close your oldest credit card account, even if you don't use it. The length of your credit history matters, and closing an old account shortens that history, which can ding your score. Also, do not go out and apply for a bunch of new credit right before or during your refinance process. No new car loan, no new store credit cards. Every application creates a hard inquiry on your report, and a flurry of them makes you look like a risk taker who's suddenly desperate for cash. To a mortgage underwriter, that's the kiss of death. Okay, engine dial number 1 credit score is tuned. Now for the second, your debt-to-income ratio or DTI. If your credit score is about your past reliability, your DTI is about your current ability to handle payments. It's the lender's stress test. They're asking a simple question. Can this person actually afford this new lower mortgage payment on top of all their other existing debts? The formula is simple. You take all your monthly debt payments, your car loan, student loans, minimum credit card payments, everything, and you divide it by your gross monthly income, which is your income before taxes. So if your total monthly debt payments are $2,000 and your gross monthly income is $6,000, your DTI is 33%. Lenders have a magic number here, and it's generally 43%. If your DTI is higher than 43%, it becomes very difficult to get approved for most loans. But to get the best rates, you want to be well below that, ideally under 36%. A low DTI tells a lender that you have plenty of breathing room in your budget. If you lost your job or had a medical emergency, you wouldn't immediately default on your mortgage. You have a cushion. A high DTI means you're living on the financial edge, and one small push could send you over. So how do we lower it? There are only 2 levers you can pull. Decrease your debt or increase your income. On the debt side, you need a focus plan. Look at all your non-mortgage debts and attack the one that will have the biggest impact. This could be paying off a small, nagging personal loan entirely to eliminate that monthly payment, or aggressively paying down the principal on your car loan. Don't just make minimum payments. Throw every extra dollar you can at your debts in the months leading up to your refinance application. And just like with your credit, now is not the time to take on any new debt. That new furniture can wait. On the income side, make sure you're documenting everything. Do you have a side hustle? Freelance income? A consistent annual bonus? Lenders will typically want to see a 2-year history for non-traditional income, so gather your tax returns, your 1099s, your invoices. If your income is solid and documented, it makes their job easier and makes you a stronger candidate. Now for the third and final dial, loan-to-value or LTV. This one is all about your house itself. LTV measures how much you owe on the loan compared to the home's current, appraised value. It's the lender's skin in the game metric. If your home is appraised at $400,000 and your loan balance is $300,000, your LTV is 75%. This number is critical because it tells the lender how much equity, how much of the home you actually own, is acting as their safety cushion. In a worst-case scenario where you default and they have to foreclose, a lower LTV means they are far more likely to sell the house and recoup all of their money. The golden number for LTV is 80%. If your LTV is above 80%, meaning you have less than 20% equity, lenders see you as a higher risk. You'll almost certainly be required to pay private mortgage insurance, or PMI, which is a useless insurance policy that protects the lender, not you, and it can add hundreds of dollars to your monthly payment. To get the best refinance rates and avoid PMI, you need to get that LTV to 80% or lower. How do you do that? First, you can influence your home's appraised value. When the appraiser comes, have your house looking its absolute best. This isn't about major renovations but curb appeal, a deep clean and fixing any small obvious issues. Also, prepare a list for the appraiser. A one-sheet document listing all the upgrades and improvements you've made since you bought the home. A new roof, an updated kitchen, a new HVAC system, along with the dates and costs. This helps them justify a higher value. You're not tricking them. You're making sure they don't miss any of the value you've added. Second, you can lower the loan part of the equation. If you know you're hovering right around that 80% LTV mark, say at 82%, it might be worth making a lump sum payment towards your principal right before you apply. Paying down a few $1,000s could be the strategic move that pushes you over the 20% equity threshold, saving you tens of thousands in the long run by avoiding PMI and securing a better rate. Some people even do what's called a cash-in refinance, where they bring money to the closing table specifically to lower their loan balance and hit that magic 80% LTV. It feels counterintuitive to spend money to save money, but in the world of mortgages, that's often exactly how the game is won. So there they are. The three master controls: your credit score, your history of trust; your DTI, your present-day capacity; and your LTV, the lender's ultimate safety net. These aren't just numbers on a page. They are the levers that determine whether you'll be offered a mediocre rate or a fantastic wealth-building rate that will change your financial future. Now that you know how to tune your own engine and transform yourself into the perfect borrower, the next question is, what kind of race are you actually trying to run? Because not all refinances are created equal. There are different types of loans for different goals. Are you just trying to lower your rate? Or do you want to pull cash out to renovate your kitchen? Choosing the right type of refinance is just as important as getting a low rate, and that's exactly where we're headed next. So let's dive right in. Think of refinancing not as a single product but as a financial Swiss Army knife. Each tool is designed for a very specific job, and grabbing the wrong one can make a simple task messy and complicated. Your goal, the why behind your decision to refinance, determines which tool you need to pull out. The most common, the one you hear about most often, is the rate and term refinance. This is the workhorse of the refinancing world. It's clean, it's simple, and its purpose is straightforward: to change the rate, the term, or both on your existing mortgage. You are not taking any cash out of your home's equity. You're simply swapping your old, less efficient loan for a new, better one. Who is this for? It's for the homeowner who looks at their monthly mortgage statement and thinks, I can do better than this. Maybe you bought your house a few years ago when interest rates were a full point or two higher than they are today. Or perhaps when you first bought your home, your credit score was just okay, maybe in the high 600s, but you've been diligently paying your bills on time for the last 5 years and now your score is approaching 800. That improved credit score makes you a much more attractive borrower to lenders, and they'll reward you with a significantly lower interest rate. Let's make this real. Imagine a couple, we'll call them Mark and Sarah. They bought their dream home for $450,000. After their down payment, they took out a 30-year fixed mortgage for $400,000 at a 6.5% interest rate. Their monthly principal and interest payment is about $2,528. They've been paying this for 3 years. Now rates have dropped and their credit is stellar. They shop around online and find they can qualify for a new 30-year fixed loan at 5.5%. They decide to do a rate and term refinance. Their new loan will be just enough to pay off the remaining balance of their old loan. Let's say it's about $388,000. What happens to their payment? Their new monthly principal and interest payment on that $388,000 at 5.5% is now roughly $2,203. That's a savings of $325 every single month. That's nearly $4,000 a year they can now put toward retirement, their kids' college fund, or just finally taking that vacation they've been dreaming about. Over the life of the loan, the interest savings are astronomical. This is the power of a simple rate and term refi. It's about optimization. You can also use it to change your loan's term. Maybe you're in a better financial position now than when you bought the house. You could refinance from a 30-year mortgage to a 15-year mortgage. Yes, your monthly payment will go up, but you will pay off your house in half the time and save a staggering amount of money in interest over the life of the loan. A 15-year mortgage also typically comes with an even lower interest rate than a 30-year, sweetening the deal even further. So a rate and term refi is your tool for pure financial efficiency, either lowering your payment or shortening your loan life. But what if your goal isn't just optimization? What if you need access to a large sum of cash? This is where we pull out the next tool from our Swiss Army knife, the cash-out refinance. This one is fundamentally different. With a cash-out refinance, you take out a new mortgage that is larger than what you currently owe on your house. You use the new loan to pay off the old one, and you receive the difference as a tax-free lump sum of cash. You are literally turning a piece of your home's equity, the value you've built up, into liquid cash. Why would anyone do this? The reasons are incredibly common. The number one reason is home improvement. Your kitchen is stuck in the 1980s, you need to replace a leaky roof, or you want to build a deck for summer barbecues. These projects can cost tens of thousands of dollars. Instead of putting it on a high-interest credit card or taking out a separate personal loan, a cash-out refinance lets you use the low-interest rate environment of a mortgage to fund the project. Another massive use for a cash-out refi is debt consolidation. Let's say you've racked up $30,000 in credit card debt, with an average interest rate of 22%. You're paying a fortune in interest every month, and it feels like you're not making any progress. You could do a cash-out refinance, pull $30,000 from your home's equity, and wipe out that high-interest debt in a single transaction. Now, instead of a 22% interest rate, that debt is folded into your new mortgage at, say, 6%. The savings can be life-changing. Other common reasons include paying for college tuition, covering major medical expenses, or even funding a new business venture. But, and this is a huge but, a cash-out refinance comes with serious considerations. You are increasing the total amount you owe on your home. You're extending the time it will take to pay it off. And most importantly, you are converting unsecured debt, like a credit card, into secured debt. If you default on your credit card, it wrecks your credit. If you default on your mortgage, you could lose your house. It's a powerful tool, but it must be used responsibly. You have to be disciplined enough not to run those credit card balances right back up again. Now, there are a couple of other, less common types of refinancing you should know about because they solve very specific problems. One is the cash-in refinance. It's the exact opposite of a cash-out. This is where you bring money to the closing table to pay down your mortgage balance. Why on earth would you do that? The primary reason is to get rid of private mortgage insurance, or PMI. If you put down less than 20% when you bought your home, you're likely paying PMI every month. It's insurance that protects the lender, not you, and it can cost hundreds of dollars a month. By bringing cash to the table to get your loan-to-value ratio below 80%, a cash-in refinance can eliminate that pesky PMI payment and often secure you a better interest rate at the same time. Finally, if you have a government-backed loan like an FHA, VA, or USDA loan, you should look into what's called a streamline refinance. These are designed to be incredibly fast and easy. They often don't require a new appraisal and have significantly less paperwork. The government wants to help you get into a lower rate and a more affordable payment, so they've streamlined the process. If you have one of these loan types, you absolutely need to ask a lender about the streamline option. So, how does all of this connect back to checking rates online? It's simple. When you go to a rate comparison website, one of the very first questions it will ask is, what is the purpose of your refinance? It will give you options like lower my rate/payment or get cash out. Your answer directly impacts the rates you're shown. Lenders view a cash-out refinance as slightly riskier than a simple rate and term refinance. Because of that increased risk, the interest rate for a cash-out refi is almost always a little bit higher, maybe 1/8 to 1/4% higher. By understanding these different types before you start shopping, you know exactly which box to check. You won't be surprised when the numbers change based on your goal. You'll be comparing apples to apples, getting an accurate picture of what you can expect to pay. Knowing your goal is the first step in getting a great deal. But it's only one part of the equation. The lender has a goal too, to make sure you're a reliable borrower who will pay them back. To do that, they look at a handful of key metrics in your financial life. These numbers are even more important than the type of loan you choose. They are the gatekeepers that determine whether you get approved at all, and more importantly, what interest rate you'll ultimately receive. We need to dissect exactly what those metrics are, and how you can prepare them to look their absolute best before you ever click that See My Rates button. Think of this process less like filling out a form and more like preparing for the most important job interview of your financial life. The lender is the hiring manager, the interest rate is your salary, and your financial documents are your resume. And right now, before you even walk in the door, we're going to make that resume absolutely bulletproof. We're going to address the 5 critical pillars that every underwriter, every algorithm, and every loan officer will scrutinize. Get these 5 things right, and you don't just get a better rate, you get to command the negotiation. First, and most importantly, is the undisputed king of the financial world, your credit score. This 3-digit number is a summary of your entire history as a borrower. It's your financial grade point average, and lenders see it as the single most reliable predictor of whether you'll pay them back. A high score screams responsible, low risk, give them our best deal. A low score whispers caution, potential trouble, charge them more to cover our risk. The difference isn't trivial. We're not talking about a few dollars. The gap between a 670 credit score and a 760 credit score on a $300,000 mortgage can be over $100,000 in extra interest payments over the life of the loan. $100,000 for a 90-point difference. Lenders think in tiers. While the exact numbers vary, generally speaking, a score above 760 is considered excellent. This is the promised land where the absolute best rates live. From 700 to 759 is good. You'll get very competitive offers. From 640 to 699, you're in fair or average territory. You can still get a loan, but the rates and fees will start to climb noticeably. Below 640, it becomes significantly more challenging and expensive. So what's the strategy? First, you need to know your number, and not from some free app that gives you a Vantage score. You need your FICO score, the one most mortgage lenders actually use. You can get this from services like myfico.com, or often through your credit card provider for free. Once you have that number, the mission is to optimize it. If you're already over 780, great, just don't do anything to mess it up. But if you're, say, at a 715, getting to 760 is a realistic and incredibly valuable goal. The single fastest way to boost your score is to attack your credit utilization ratio. This is simply the amount of credit card debt you have compared to your total credit limit. If you have a $10,000 limit and a $5,000 balance, your utilization is 50%. Lenders hate seeing that. They want to see it below 30% and ideally below 10%. Paying down your credit card balances is the quickest way to get a significant point bump in 30 to 45 days. Second, pull your full credit reports from all three bureaus. It's free once a year, and scan them for errors. A late payment that wasn't late? A collection account that isn't yours? These errors are surprisingly common and can be anchors dragging your score down. Dispute them immediately. Finally, and this is crucial, in the 6 months leading up to your refinance application, do not open any new credit accounts. No new car loans, no new credit cards, no save 10% at the register offers. Every new inquiry is a small hit to your score and makes you look financially unstable to a lender. The second pillar, standing shoulder to shoulder with your credit score, is your debt-to-income ratio, or DTI. If your credit score is your history, your DTI is your present. It's a snapshot of your current financial stress level. The formula is simple. It's your total monthly debt payments that includes your proposed new mortgage payment, car loans, student loans, credit card minimums, divided by your gross monthly income before taxes. A lender looks at this number to see how much breathing room you have in your budget. If your DTI is too high, they get nervous. Even if you've never missed a payment in your life, a high DTI suggests you're stretched thin, and one unexpected expense, a medical bill, a car repair, could push you over the edge. So what's the magic number? Most lenders want to see a DTI of 43% or lower. Some government-backed loans might go a little higher, but 43 is the standard ceiling. However, to get the absolute best rates, you want to be under 40% and ideally closer to 36%. There are two ways to improve your DTI: decrease your debt or increase your income. The debt side is straightforward. Pay things off. Prioritize high-interest revolving debt like credit cards, as this also helps your credit score. But don't neglect the income side of the equation. This is where people leave money on the table. Are you documenting every single source of income? Do you have a side hustle? Do you get regular bonuses or commissions? Lenders will typically want to see a 2-year history of that variable income, but if you have it, make sure it's on the application. For self-employed individuals, this is paramount. Your income isn't just a number on a W-2. It's a story you tell through 2 years of tax returns and a profit and loss statement. Present it clearly and professionally. Don't let a lazy calculation of your income be the thing that pushes your DTI over the edge and costs you thousands. The third pillar is your loan-to-value ratio, or LTV. This is all about equity. It's a measure of how much skin you have in the game. The formula is your loan amount divided by the appraised value of your home. If your home is appraised at $400,000 and you're refinancing a $300,000 loan, your LTV is 75%. This means you have 25% equity. From a lender's perspective, equity is a massive safety cushion. If you default on the loan, they know they can sell the house and are very likely to get all their money back. The more equity you have, meaning the lower your LTV, the safer you are as a borrower. The critical threshold here is 80% LTV. If you have to borrow more than 80% of your home's value, you'll almost certainly be required to pay private mortgage insurance, or PMI, which is an extra monthly fee that protects the lender, not you. It's essentially a penalty for having low equity. When refinancing, your goal should be to stay at or below that 80% LTV mark. This is where the home appraisal becomes a make or break moment. If the appraisal comes in lower than you expect, it can throw your LTV out of whack and potentially kill the deal or force you into a worse loan product. So prepare for the appraiser. Have a list of recent upgrades and improvements ready. Make sure the house is clean and accessible. You want to give them every reason to see your home in its best possible light to secure the highest possible value. Pillar number 4 is your cash reserves. Lenders call them liquid assets. This is your emergency parachute. After you pay all your closing costs, the lender wants to see that you still have money in the bank. Why? Because if you lose your job the month after you close, they want to know you can still make your mortgage payments for a while until you get back on your feet. It's all about risk mitigation. Generally, they want to see that you have enough in reserves to cover anywhere from 2 to 6 months of your full monthly housing payment. That's principal, interest, taxes, and insurance. What counts as reserves? Checking and savings accounts are best. Vested funds in 401(k), or other retirement accounts can also count, though they may only consider a percentage of the value. The key is to have these funds seasoned, meaning they've been in your account for at least a couple of months. A large, sudden deposit right before you apply will raise red flags and require a mountain of paperwork to explain. Finally, the 5th pillar is your employment history and income stability. This is the foundation upon which everything else is built. A lender isn't just lending to you today. They're lending to the you who will be making payments for the next 30 years. They need to believe your income is stable and reliable. The industry standard is a 2-year history of consistent employment, preferably in the same line of work. Have you recently changed jobs? That's usually okay if it was a promotion or a move for higher pay within the same field. Are you a recent graduate who just started your career? Many lenders have programs for that. Are you self-employed or a gig worker? It's absolutely possible, but be prepared for a much deeper dive into your finances. You'll need at least 2 years of tax returns showing consistent or growing income. The bottom line is, you need to prove that your ability to earn is not a fluke. It's a stable, predictable pattern. Your credit score, your DTI, your LTV, your cash reserves, and your employment stability. These are the 5 metrics that will determine your fate. Master them and you control the process. Neglect them and the process controls you. By taking the time to review and polish each of these 5 pillars before you start shopping, you're transforming yourself from a hopeful applicant into a prime candidate. You're not just asking for a low rate. You're showing them with undeniable data that you deserve one. So now the real question is, where do you actually go to find these rates? You've spent weeks, maybe months, getting your financial house in order. Your credit score is gleaming. Your DTI is lean. Your documentation is stacked and ready. It's time to go hunting. But this isn't a chaotic spray and pray hunt. This is a calculated 3-phase surgical strike designed to extract the absolute best offer from the market without tipping your hand too early or damaging your credit score in the process. Phase 1 is what I call the reconnaissance mission. Your objective here is to get the lay of the land completely anonymously. You're a ghost. You're gathering intel without leaving a trace. You're going to open your browser and head to 3 types of places. First, the major national banks, think Chase, Bank of America, Wells Fargo. They have mortgage rate tables right on their websites. Second, the big online-only lenders, companies like Rocket Mortgage, Better.com, LoanDepot. They built their entire business on this. And third, the aggregators, sites like NerdWallet, Bankrate, and Zillow. These are marketplaces that pull in advertised rates from dozens of different lenders. On all of these sites, you'll find mortgage calculators. This is your training ground. You'll enter your zip code, your estimated home value, the amount you want to refinance, and the credit score tier you know you belong in because you did the work. Click Calculate. What you'll see are the advertised rates or sample rates. And I need you to burn this into your brain. These are not real offers. These are marketing tools. They are the perfectly photoshopped billboard rates, designed for a mythical borrower with an 850 credit score, 50% equity, and a W-2 from a Fortune 500 company. That's probably not you. But that's okay. The point of Phase 1 isn't to get a real offer. It's to establish a baseline. You're looking for trends. Is one lender consistently a quarter point lower than everyone else in their advertising? Is one aggregator showing you a small local credit union you'd never heard of with a shockingly good rate? You are taking notes, making a list, and identifying your primary targets. You do this for an hour, and you'll have a better feel for the market than 90% of homeowners. You've done all this without giving anyone your name, your email, or your social security number. No sales calls, no spam. You're still a ghost. Now we move to phase 2, the soft inquiry strike. You've identified, let's say, 5 to 7 promising lenders from your reconnaissance. It's time to get a little closer and see if their advertised rates hold any water. On their websites, you're going to look for a button that says something like, "See your personalized rate," or "Get pre-qualified." This is a step beyond the anonymous calculator. Here you will have to provide your name, address, and probably your income, and you will have to give them permission to check your credit. But, and this is the most important part of this phase, you are only looking for lenders who will perform a soft credit inquiry. Let's be crystal clear about the difference, because this is where so many people get scared and stop shopping. A soft inquiry or a soft pull is like a background check. It lets the lender see your credit report and score, but it is not visible to other lenders and it has zero impact on your credit score. A hard inquiry, on the other hand, is an official application for credit. It gets stamped on your report, and too many of them in a short period can ding your score. So how do you know which one you're agreeing to? The lender has to tell you. Before you click submit, there will be disclosure text. Read it. You are looking for language like, "Checking your rate won't affect your credit score." If you see that, you're good to go. If it says you're authorizing a credit inquiry or credit report as part of a formal application, you've gone too far. Back up. That's phase 3. By completing phase 2 with your top 5 to 7 lenders, you're forcing them to move beyond their billboard rates. They now have your actual credit profile, and they can give you a much more realistic quote. This is where the herd thins. You'll find that some lenders' flashy advertised rates suddenly get a lot less attractive once they see your real numbers. Others might actually come in better than you expected. Your job is to look at these personalized but still unofficial offers and narrow your list down to the top 3, maybe 4 contenders. These are your finalists, the ones who have proven through a soft pull that they are serious about competing for your business. Now for the final move. Phase 3, the coordinated application. This is where you go from shopper to applicant. This is where you get the legally binding offers that you can actually sign. You are going to take your list of 3 or 4 finalists and you are going to apply for real to all of them. On the same day. Yes, on the very same day. This is the power move that separates the amateurs from the pros. And I know what you're thinking. Won't applying to 4 different lenders destroy my credit score? You just told me hard inquiries are bad. And you're right to be cautious. But this is where understanding the system gives you an incredible advantage. The credit scoring models, whether it's FICO or VantageScore, are smart. They know that people don't buy 4 houses at once. They know that when you're shopping for a major loan like a mortgage, a car loan, or a student loan, you need to apply to multiple lenders to compare offers. So they created something called a rate shopping window. Any hard inquiries for the same type of loan that all occur within this window are treated by the scoring algorithm as a single inquiry. One single hit. The length of the window varies by the scoring model, but it's typically anywhere from 14 to 45 days. To be safe and to show lenders you're a decisive, organized borrower, you do it all in one day. Monday morning, you apply to lender A. Monday lunch, you apply to lender B. Monday afternoon, lenders C and D. As far as your credit score is concerned, you just made one single inquiry. You get all the benefits of comparison shopping with the minimum possible impact on your score. This single piece of knowledge can save you tens of thousands of dollars because it removes the fear that prevents people from getting competing offers. Within 1 to 3 business days of submitting these full applications, each lender is legally required to send you a standardized federal document. It's called the loan estimate. This 3-page form is the holy grail of mortgage shopping. It breaks down every single detail of the proposed loan. The interest rate, the APR, the closing costs, the monthly payment, everything. You now have in your hands 3 to 4 competing official signable offers. You've executed the plan perfectly. You went from an anonymous ghost to a pre-qualified shopper to a fully vetted applicant with multiple lenders fighting for your business. You have all the power. But here's the final crucial trap. These loan estimates, while standardized, are still dense, confusing documents, and lenders are masters at using the fine print to their advantage. One offer might have a slightly lower interest rate, but it's packed with thousands of dollars in hidden junk fees in Section B. Another might have low fees but a higher APR that tells a different story about the true cost of the loan. Getting the offers is only half the battle. Knowing how to read them, how to compare them line by line like a forensic accountant, and how to spot the tricks that cost unprepared borrowers a fortune, well, that's the final secret. That's how you truly know you've won. So let's break down that final secret. You have 3, maybe 4 loan estimates sitting in front of you. This is the moment of truth. And the first thing you need to realize is that the US government has given you a superpower. It's called the Loan Estimate, or LE. This 3-page document is legally standardized. That means every single lender, from the biggest bank in the country to the smallest local credit union, has to use the exact same form. They have to put the same information in the same boxes. They have nowhere to hide. This is your battleground, and you now know the terrain better than they think you do. Forget the fancy marketing. Ignore the smiling loan officer on the phone for a minute. Just look at the paper. Page 2 is where the war is won or lost. Look at the section called Closing Cost Details. You'll see a column for loan costs and another for other costs. Let's focus on loan costs first. This is the lender's world. Box A. Origination charges. This is the single most important box on the entire form. This is the lender's pure profit. It's what they are charging you directly for the service of creating your loan. It might be listed as one lump sum, or it might be broken down into things like an application fee, underwriting fee, or processing fee. It doesn't matter what they call it. It's their paycheck. When you compare loan estimate A to loan estimate B, if one lender is charging you $2,000 in box A and another is charging $900, that's an $1,100 difference you can see in 5 seconds. This is your number 1 negotiation point. It is almost always negotiable. Next, box B. Services you cannot shop for. This sounds intimidating, but it's actually a huge tell. These are fees for third-party services that the lender chooses on your behalf. Think appraisal fee, credit report fee, flood determination fee. You can't pick the appraiser, but you can compare what each lender is charging for that appraisal. If lender A is charging $600 for an appraisal and lender B is charging $900 for a house in the same area, you have to ask why. Is one of them padding the fee? It's a massive red flag. You use this discrepancy as leverage. You go to lender B and say, "Why is your appraisal fee 50% higher than the competition?" Watch them squirm. Then you get to the gold mine. Box C. Services you can shop for. This is where you take back control. These are third-party services that you have the legal right to find on your own. The big one here is title insurance. The lender will put an estimate in this box from their preferred title company. But preferred for who? Them or you? You should absolutely be getting your own quotes for title services. The same goes for a pest inspection or a survey fee if they're required. Finding your own provider for these services can save you another $500 to $1,000 easily. You are not obligated to use their guy. So you add up box A, B, and C. That gives you your total loan costs. This is the first major number you compare across all your offers. Don't just look at the interest rate. A lender could offer you a slightly lower rate, but slam you with $3,000 more in loan costs. It happens every single day. But we're not done. We have to talk about the sneakiest parts of the mortgage game. Points, credits, and the all-powerful APR. Let's start with points or discount points. Look on page 1 of your loan estimate. You'll see the interest rate. Right near it, you might see a charge for points. 1 point costs 1% of your total loan amount. So on a $400,000 loan, 1 point is a $4,000 fee you pay up front at closing. Why would anyone do this? Because paying that point buys down your interest rate. Maybe it takes it from 7% down to 6.75%. The lender will sell this as a great deal. Pay a little now, save a lot later. Here's how you call their bluff. You do the break-even calculation. First, figure out the monthly savings. The difference between a payment at 7% and 6.75% on that $400,000 loan is about $67 a month. Now, take the cost of the point, $4,000, and divide it by your monthly savings of $67. The answer is 59.7. It will take you almost 60 months or 5 full years just to break even on the cost of that point. If you plan to sell your house or refinance again in the next 5 years, you will have literally thrown that $4,000 away. Most people move or refinance within 7 to 10 years. Suddenly, paying for points doesn't sound so smart, does it? Unless you are 100% certain you'll be in that house and that loan for the long haul, say no to points. The opposite of points are lender credits. This is where the lender gives you money to apply toward your closing costs. Sounds like a gift, but it's not. It's a trade. In exchange for those credits, you agree to take a higher interest rate. This might be a good strategy if you're short on cash for closing, but make no mistake, you will pay for it, and then some, with a higher monthly payment for years and years to come. This brings us to the final weapon in your arsenal, the APR. The annual percentage rate. People confuse this with the interest rate all the time, and lenders love that confusion. The interest rate is simply the cost to borrow the money. The APR, however, is a broader measure of the loan's cost. It takes the interest rate and factors in many of the closing costs like the origination fees and the points. Think of it this way. The APR is the truer cost of your loan. This is why it's a devastatingly effective comparison tool. You might have two offers, both with a 7% interest rate. But offer A has an APR of 7.15%, and offer B has an APR of 7.35%. That difference tells you, without having to be a math genius, that offer B is loaded with higher fees. The loan is more expensive, even though the advertised rate is identical. When you're comparing loans with the same rate, the one with the lower APR is almost always the better deal. So now you have the complete playbook. You're not just looking at the interest rate anymore. You're a financial detective. You line up your loan estimates side by side. You compare box A, the lender's profit. You question the fees in box B. You get your own quotes for the services in box C. You do the break-even math on any points. And you use the APR as your ultimate lie detector test. And then you make the call. You don't ask, you state. Hello, lender A. I'm looking at your offer next to one from lender B. You both have me at the same rate, but lender B's origination charge is $1,000 less than yours, and their APR is lower. I'd prefer to work with you, but you need to match or beat that offer. You have created a competitive environment. You've turned their sales process into a bidding war where you are the prize. You're not just a name on an application anymore. You are an educated, informed consumer with multiple options who cannot be fooled. This is the power they never want you to have. This entire journey, from that first online search to this final negotiation, is about shifting the balance of power. The system is built to make you feel rushed, confused, and grateful for any offer you can get. But you now know the truth. The tools are right in front of you. The internet gave you access, but knowledge gives you leverage. Checking rates online was just the first step. Understanding how to dissect the offers, how to read the language of the industry, and how to use one lender's offer against another, that is how you secure a deal that can save you tens of thousands, even hundreds of thousands of dollars over the life of your loan. You didn't just learn how to check rates. You learned how to master the game. Now go win it.